Welcome to Breaking News to Trading Moves. Welcome to the debate. Imagine losing $10,000 today, not because you made a calculated risk that went against you, but, well, simply because you couldn't sit still for 2 hours.
Oh, yeah, that is brutal.
Right? I mean, in trading, boredom is mathematically the most expensive emotion you can experience.
It really is. In almost every other profession, physical action equals productivity. You swing a hammer, you bill an hour, you generate revenue.
Exactly. You do the work, you get paid.
But in the financial markets, that equation it completely shatters. Sometimes doing absolutely nothing is the highest yielding decision you can make.
And that is exactly what we are looking at today, the intense reality of non-participation. We are framing this around a very specific question. When a trader forces an entry in suboptimal conditions,
Like when they know they shouldn't be in the market.
right, when they know they should be flat, but they click buy anyway, what is the true cost? We are connecting the dots to risk management literature that highlights the stark distinction between mere activity and actual progress in the markets.
Yeah.
So, my stance, what I will be arguing, is that the primary damage here is psychological. It is the insidious decay of discipline. You habituate trading without a verifiable edge. And, well, once that mental framework breaks, your career is essentially over.
And I approach this from the opposite side. The primary damage is financial. It is the immediate reduction of your capital and the literal loss of future buying power.
The actual dollars and cents?
Exactly. Cash is an active position. Without capital, your internal discipline and your pristine psychological state are rendered entirely irrelevant. The math of survival dictates everything.
Okay, let me expand on why the psychological cost is so devastating. Because if you are listening to this and you have ever taken a trade just because you had a free hour at lunch,
The classic boredom trade.
right, the boredom trade, you know exactly what this decay feels like. You take a loss, it hurts financially, yes, but the real destruction is what happens to your neural pathways.
Neural pathways?
Yes, I mean, you are teaching your brain that it is acceptable to execute orders outside of your proven framework. You bypass the logical filter and operate purely on impulse. And when you do that, one poorly planned entry often leads directly to another. You try to make the money back, which leads to revenge trading. And look, financial losses can be recovered. You can refund a brokerage account.
True.
But repairing a broken process, rebuilding the trust you have in your own ability to execute, that takes months, if not years. If your process breaks down, your ability to execute any future edge is entirely compromised.
Look, I hear what you are saying about the neural pathways, but let me present the strict mechanics of capital preservation. I focus on the literal math of the account.
Okay, let's hear the math.
Holding cash preserves total flexibility. It allows you to return tomorrow with full buying power. When you force a trade and take a loss, you are not just losing a percentage of your account.
You mean you lose the opportunity?
Yes, you are losing the capacity to act when a high probability opportunity actually appears. The math of survival must come first. You do not lose money by missing a random, erratic move that did not fit your plan.
Right, missing a trade is free.
Exactly, missing it is free. You lose money when you throw capital at noise. I continually question this assumption that psychology precedes math.
But it does. If your head isn't right,
But wait, if your account drops to zero, your disciplined mindset cannot buy a single share. It just can't. External resources dictate your reality.
I get that, but if we're going to weigh the psychological decay against the financial ruin, we have to look at the exact moment a trader decides to step away.
The trigger for going flat?
Right? To understand which cost is truly heavier, we have to examine what actually triggers a no-trade day in the real world. Deciding to stay flat is primarily an internal gating mechanism. I don't know about that. Hear me out. Top-tier risk managers know that if they are fatigued, emotionally compromised, or just distracted, their system cannot function. The human mind is the engine of the strategy. Okay. Think of a military sniper adjusting for wind speed and distance. If the sniper has barely slept, their heart rate is spiking, and their hands are shaking.
They shouldn't take the shot?
Exactly. Pulling the trigger guarantees a miss, regardless of how perfectly calibrated the rifle is. The internal state supersedes the external conditions. An emotionally compromised trader will look at a completely chaotic, untradeable chart and hallucinate a setup just to justify clicking the button.
I'm sorry, but I just don't buy that. Let me tell you why.
Go for it.
That sniper analogy is vivid, I'll give you that, but it assumes the trader is the physical instrument of execution in a vacuum. In financial markets, the external environment, the math, is the only thing that actually generates a return.
But the trader has to execute.
Sure, but the sniper shaking hands only matter if there is an actual target. Let us look at volatility extremes. When market volatility spikes without a clear catalyst, price swings become entirely erratic.
The noise increases.
Right. To avoid getting stopped out by standard market noise, you are forced to widen your stop loss. But widening your stop loss means taking on more financial risk.
Unless you adjust position size.
Exactly. To keep your risk parameters constant, you must reduce your position size. But if you reduce it too much, the absolute monetary reward no longer justifies the risk. The expected value is mathematically broken.
Well, yes, the math changes.
It absolutely does not matter if the trader is perfectly rested and operating in a state of Zen-like calm. If the math does not offer a favorable expectation, putting capital at risk destroys the account. The external metrics act as the primary objective filter.
Wait, I have to stop you there. You say it's just math, but we both know traders who stare at perfectly calculated, terrible risk-to-reward ratios and click buy anyway.
Because they aren't following the plan.
Because they are down on the week and desperate to recover? How can you say math overrides human panic? That mathematical filter you rely on is entirely dependent on the trader having the mental fortitude to respect it in real time.
I'm not saying they don't panic.
But if you lack discipline, the math is completely invisible to you.
They ignore the math, and what happens? The market punishes them financially. The market does not care why they click the button. It only processes the order.
True. The market is indifferent.
Completely indifferent. When a trader ignores the objective data, like major economic news creating unpredictable price action, they invalidate their statistical edge. The evidence shows us that the market does not reward time spent staring at a monitor.
No, it certainly doesn't.
It rewards precise decisions based on empirical evidence. If they trade out of panic, the consequence is measured purely in lost dollars. The psychology only matters because it leads to a mathematical error.
I see why you think that, but let me give you a different perspective. If we accept that a bad mindset leads to a mathematical error, that dictates how we spend our time when we correctly choose to stay out of the market.
How do you mean?
Well, activity is not progress, but a day without an open position does not have to be wasted. This time must be used for reflective, process-oriented tasks to repair those exact psychological vulnerabilities we just talked about.
Okay, so staring at a journal instead of the charts.
Not just staring. How do you actually conduct that reflection? It isn't just looking at the red number on your profit and loss statement. It is pulling up the chart from the exact minute you entered the trade.
Checking the execution.
Right. It is looking at the context. Did the volume support the move? Was there a catalyst? And then crucially asking yourself, what was I feeling in that exact moment? Was I anxious because I missed the move earlier in the morning?
Identifying the tilt.
Yes. Identifying those specific emotional triggers is the only way to build a defense mechanism against them. If you do not map your emotional errors as meticulously as you map your chart, you will repeat them.
If I can jump in, I see why mapping emotional errors feels productive. But reflection is a luxury afforded only by the preservation of capital.
A luxury?
Yes, I come at it from a different way. If you spend your downtime solely looking backward at how you lost your mental edge, you miss the structural data forming right in front of you.
But the market isn't going anywhere.
No, but the clues are being laid down right now. Let us talk about how relative strength actually works during a market sell-off.
Okay.
If the broader index is dropping aggressively all morning, but you spot a specific sector, say semiconductors, holding perfectly flat and refusing to break its morning lows, that is not an accident.
No, it's institutional buying.
Exactly. That relative strength tells you exactly where institutional capital is hiding. They are accumulating shares while retail panics. Finding those footprints is what creates long-term value because it directly translates to your next mathematical edge.
Sure.
The market is entirely indifferent to your emotional journey. It only respects the timing and the risk parameters of the next order. Tactical preparation is what actually pays you.
But how do you execute that tactical preparation if your baseline discipline is fractured?
What do you mean? The data is right there.
Yes, but if you were only mapping out tomorrow's support zones without reflecting on why you chased a bad entry today, you will just drag those same errors into tomorrow.
Well, you have to follow the stops.
But people don't. You can have the most beautifully annotated charts in the world, identifying every piece of relative strength, but if you have a habit of abandoning your plan the second the opening bell rings, your tactical prep is useless.
That just goes back to following the math.
But reflection bridges the gap between intention and execution. I would argue that identifying relative strength requires an incredibly clear, unbiased mind.
I agree with that.
Right, so if a trader's holding onto a losing position in a weak sector because their ego won't let them take a loss, they are blind to the relative strength happening elsewhere. They are paralyzed.
Yeah, the deer in headlights.
Exactly. The psychological blockage literally prevents them from seeing the objective data you are talking about.
See, that is exactly why holding cash is so powerful. Cash eliminates that psychological blockage.
How so? By just not playing?
By being flat. When you are in cash, you have no bias. You are not hoping for a bounce. You are not praying for a reversal. You are simply observing the data.
Okay, I see that.
By stepping out of the market, you reset both your account risk and your emotional bias. That is why I argue the financial position, being in cash, dictates the mental state, not the other way around.
This tension between internal reflection and external mapping really defines what it means to be a professional. To me, professionalism is entirely about restraint.
I can agree with restraint.
It is defined by what a trader refuses to do. Professional risk managers use specific internal checklists before entering a trade, and those checklists are essentially psychological barriers designed to test their discipline.
Let us look closely at those checklists, though. Are they truly psychological?
They absolutely are. A checklist asks, is the market structure clear? Is there a defined catalyst?
But those are market structure questions, not emotional ones.
But overcoming the urge to trade without those conditions is a psychological triumph. When you demand that the market prove itself to you before you risk a single dollar, you are exercising supreme emotional control.
Well, it's just following the rules.
But following rules is hard. Furthermore, when you force a trade on a day with no clear catalyst, you aren't just taking a random walk. You are actively stepping into an arena where institutional algorithms are designed to hunt retail liquidity.
That is definitely true on low-volume days.
Yes, on low-volume days, algorithms will push price just past obvious support levels to trigger the stop losses of impatient traders, absorb that liquidity, and then just reverse the price.
The classic stop run.
Exactly. If you trade out of boredom, you are essentially volunteering to be the liquidity for an institutional machine. And I'm telling you, the psychological damage of getting stopped out only to watch the price reverse in your original direction is catastrophic for your discipline.
That is a compelling argument, but have you considered that you are elevating the emotional control above the structural reality that demands it?
I think they are one and the same.
I don't. Professionalism is strictly about resource management. The math of survival dictates the restraint. We all know the basic math, right? Losing 50% of your capital requires a 100% return just to recover to break even.
Yes, the math gets brutal quickly.
But let us look at the velocity of a drawdown. As your capital shrinks, your buying power decreases. If you are risking a fixed percentage of your account per trade, the actual dollar amount gets smaller and smaller.
Right, you are trading smaller size.
This means that when the highest probability setup finally arrives, your position size is mathematically restricted. You are marginalized. Holding cash preserves your absolute maximum buying power for the exact moment the expected value is highest.
Okay, so it's a resource allocation model.
Exactly. A professional operates like a capital allocator. If the stop-loss distance requires reducing the position size so much that the absolute dollar return isn't worth the risk, they refuse the trade. It is an economic reality, not a psychological victory.
I'm not convinced by that line of reasoning because a purely economic calculation ignores the human element of execution.
The execution should just be clicking a button when the criteria are met.
Sure, should be. But let me ask you this. What happens when the setup is perfect, the math aligns, the expected value is positive, but the trader hesitates?
Why would they hesitate if the math is perfect?
Because they missed the entry because their confidence was destroyed by 3 forced trades earlier in the week.
Ah, I see.
The math was perfect, but the execution failed because the psychological capital was depleted. That is why I maintain that the primary cost of forcing bad trades is the decay of your process. You are eroding the very mechanism of your mind that allows you to capitalize on the math when it finally aligns.
That is a fair scenario. Hesitation is a direct result of degraded confidence. I won't argue that. But I come at it from a different way.
How so?
Boredom, the catalyst for those bad trades, only becomes destructive when it meets a lack of tactical preparation. If a trader is properly managing their resources, actively scanning for relative strength, and evaluating the volatility metrics, they simply do not have time to be bored.
So the prep keeps them engaged.
Precisely. The professional treats cash as an active, demanding position. They understand that by doing nothing, they are doing something critical. They are preserving their ammunition.
Right. When you stop treating every intraday fluctuation as your only chance to make a living, the execution becomes objective. That is a calculation of probability, not an exercise of psychological endurance.
I think we have really laid out both sides here. As we wrap up this exchange, my core premise remains that protecting your mental process and avoiding edgeless trading is paramount. A forced trade damages confidence, triggers a destructive cycle of revenge trading, and builds the insidious habit of acting on impulse rather than evidence. Your mind is the ultimate execution algorithm, and, well, if you corrupt its code, no amount of market opportunity will save you.
And I maintain that protecting physical capital and buying power is the ultimate arbiter of survival. The strict mechanics of risk management ensure that you have the resources to capture genuine opportunity.
You need the cash to play.
Exactly. Cash is an active position. Without capital, your psychological state, no matter how disciplined, cannot generate a return.
Well, despite our different angles on the mechanism of failure, I think we both entirely agree on the core reality. Activity is not progress.
Oh, 100%.
The market does not reward screen time. It does not care how many hours you put in, and a forced trade is universally destructive to a portfolio.
Absolutely. Understanding both the mathematical costs to your buying power and the psychological toll on your discipline creates a much more resilient trader. You really cannot survive without a profound respect for both sides of the coin.
There is definitely a lot more to explore here. We barely scratched the surface on the exact mechanics of identifying institutional algorithms hunting retail stop losses during low volatility days.
Oh, we could spend a whole hour just on that. Or on how to practically define market structure clarity when the larger time frames conflict with the intraday charts.
Right. Both are critical components for anyone looking to refine their forward-looking preparation. But we will leave it to you, the listener, to evaluate your own execution.
Yep.
Next time you find yourself staring at a directionless chart, feeling the urge to click a button just to feel productive, ask yourself what you are truly risking. Is it just a tiny fraction of your account, or is it the foundation of your entire discipline? Thanks for joining us.